The market volatility can be stressful, overwhelming and scary when you see your gains vanish and your whole portfolio turning red, and you feel the urge to sell everything and be done with it. Don't. The key making money is buying low and selling high. Hi folks, it's Björn here, and in today's video I will show you the best strategies for a volatile market so you can take advantage of the market correction and learn why a correction can be actually your best friend. Starting right now. I understand that market downturns can be overwhelming and scary as you watch the price of your holdings fall. It can be tempting to sell or pause it. Peter Lynch once said, "The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed." Investors who succeed in the stock market also accept periodic losses, setbacks and unexpected occurrences. I see a lot of panic in the markets that circulate around the fears of Fed interest rate hikes, inflation, supply chain issues, Omicron, slowing growth and workers shortage. But while these issues may seem frightening and the Fed rate increase may be inevitable, there is no need to panic. These problems and concerns are not guarantees of an economic crash or a recession. Markets move up and down based on investor sentiment. Just a few weeks ago, on January the 4th, 2022, the S&P 500 hit its all-time high, and you have to understand that currently the market shifts from growth to value, and therefore many companies in sectors such as energy, finance, material and REITs have strong earning results during the periods of an inflation. Knowing all this, let's start with the 4 best tips I can give you for investing in a volatile market. First, stay invested and think long term. Losses are not made when you sell. Historically seen, market volatility tends to be temporary, and it usually pays to keep your money invested. To watch your investments fall in value, whether you're a newbie or a veteran in trading, is terrifying. Withdrawing this money from the market is a risk that needs to be carefully considered, because if you withdraw, you risk locking in losses. If you buy at higher price and sell after a price drop, you are selling for less than you paid for. If the price recovers, you have lost nothing. The reason staying invested is so important is because the best days in the market traditionally follow the worst days, and it's impossible to time the market precisely and accurately. It's important to avoid the typical investor trap of capitulating in volatile times. Exciting the market because of fear to minimize loss may result in bigger losses or missing the best days of trading in volatile markets. Hence, stay invested and think long term. Please remember this, folks. Second, don't sit on your cash and put your money to work. Remember, inflation, folks. Sitting on cash, especially in the current inflationary environment, is like throwing money away or lighting it on fire. If $100 that sat in cash last year is only worth $93 today, given the 7% inflation, taking that forward, even if inflation moderates back to the Fed's target of 2%, even then today's 93 will be worth less over the next year because of the impact of inflation. And that stands against if you would invest $1,000 in a stock, all you can lose is $1,000, but you have the chance to gain $10,000 or even $100,000 over the time if you are patient. So if you find yourself in a stable position right now, where you have a stable source of income, you have an emergency fund and you have low living expenses, market volatility presents a great potential to buy shares at better valuations. Downturns are an effective way to improve the quality of your portfolio by increasing holdings to higher quality companies that may have been expensive, overstretched or outside of your price target. Another important thing to know, and I explained it in another video where I talked about if buying the dip or regular investing at all-time highs is better. And the result was, over the long term, one of the best investment strategies to maximize returns and reduce risk is through dollar cost averaging, DCA. And DCA is the practice of systematically investing your cash over regular intervals, regardless of stock price. DCA is one of the most effective strategies for investors looking to smooth out the natural dips and rips that occur in the markets, as DCA also helps to avoid the mistake of trying to time the markets. Third, educate yourself and analyze your stocks carefully. The internet and the stock market are full of tips for getting rich quickly. Putting your money into investments simply out of fear of missing out without ever reading the fine print or failing to understand the investment can set you up for an emotional instability, and in order to prevent that, you should ask yourself, do I know the product that this company manufactures? The main product as well and the main sales driver. For example, if you have a SoFi, then you can say, yes, okay, I use SoFi myself as a bank or a broker. Check. That is the first point. Look at the companies, look at the management and look at the products, and then only when you decide, okay, this business is something for me, I can identify with the management, I can identify with the products, maybe even use these products myself. Only then you have to go to step 2 and 3 and take a closer look at the financial numbers and pick stocks that have strong fundamentals and will benefit you in the long run. So look into your portfolio and go through most of the positions in your stocks, and don't forget you are here for the long-term game. You are here as a long-term investor. That is, you have already analyzed the companies, I hope you did, and have therefore invested in them. Means your feeling should be that if you had enough money, you would prefer to buy all the shares or the whole company. Fourth, diversify and focus on good companies. With the current sell-off, you may find success in identifying stocks with fair valuations that are a fair price and have taken a huge hit during the market volatility, just naming Netflix, AMD, or actually most of the fintech stocks. Hence, provided there is no recession, this correction is presenting opportunities to invest in quality and in value. And as I mentioned before, it pays to be diversified and own some of the consumer stocks like food, beverages, and personal hygiene, like Coca-Cola or Johnson & Johnson, or utility stocks like electric, gas, water, or communication. And if you believe inflation is a concern, then you would want to invest in energy stocks like ExxonMobil or financial stocks. Plus, I would as well invest in some dividend stocks, as dividends offer a buffer to the downside. Anyway, the key to long-term investing is finding high-quality companies, stocks that are characterized with sustainable growth, solid valuation frameworks, robust profits, positive earnings revisions, and strong momentum compared to peers. As Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That being said, if you liked the video, please give me a thumbs up so that other retail investors like you and me have the chance to see this video as well. And if you're on my channel for the first time, I would be happy if you would subscribe, because I regularly produce new videos and tutorials on the topics of stock analysis, investment, and financial products to give you the opportunity to take your finance into your own hands. That's it for today. Thanks for watching, and as always, stay focused and don't get greedy. See you next time.